you think life is simpler as time evolves, for some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. This week we return to the topic of money. Yeah, one thing about it, we could do a show and only talk about money, and I think that that'd be fine with our audience. Jill.
Definitely.
But we feel like we need to circle back periodically, though, and focus specifically on this issue because we know it's on your minds as listeners. We know that as people get older, there's less margin for error, as we've talked about. It's little consolation to you if you're 70 years old and there's a crash in the market and you're told that, oh, but in the long run, it'll be okay. You know, you got to think. You can tell a 20-year-old, think of a 30-year horizon. But you can't tell a 70, 75, 80-year-old to think of a 30-year horizon.
No, that's something you don't want to hear at 70.
No. So anyway, we have with us today somebody who is an authority in this field. Do you want to introduce our guest, Jill?
I definitely do. We want to welcome back John Gallia. He's a certified financial planner of Gallia Wealth Management in Creve Coeur. Welcome back, John. And how's the new baby?
Oh, well, first, thanks for having me. The babies are good. I have a 3-year-old and a 10-month-old, and I was talking to my wife. It's kind of funny. They go from sleeping, they don't wake up. They go from sleeping to we have liftoff.
I wish I had that kind of energy.
There's nothing in between, right?
It's 0 to 10. And one of the benefits, there's a lot of benefits of having children later in life, like my wife and myself did. But one of the things that's not a benefit is the energy level. I wish I had the energy level of a 20-year-old.
Well, and I think you don't mind this question. How old are you?
I just turned 40.
Okay. Well, you know, you're about where I was. I had my first child when I was 37. And then my last, I have 2 daughters, when I guess I was 39 or so. So, yeah, you know, I think having kids when you're older gives a lot of depth to your perspective. I really think there are a lot of benefits. There are some drawbacks,
I think so too,
as you point out, but there are a lot of benefits. You agree with this, Jill?
I do, because we just adopted 2 teenagers. And, you know, we thought, younger children, do we have that energy? No. And now that we're older, I think there's wisdom. And you know how to parent better, maybe, than, say, if you had these children when you were in your 20s.
There's a maturity level that you get with age.
Yeah, but there's no warming up for you. I mean, it's like 0 to 20.
Yes.
You know, where suddenly you are managing arguably the most challenging period.
You can
in
say
kids'
that again.
lives.
You
Sure.
can say
Sure.
And you're holding up.
I am. By the grace of God, I'm holding up, but there's never a dull moment in our household.
Well, you know, and those are the things that give life meaning. I'm a huge fan of having kids, whether they're adopted, whatever way they're had. I think that people who go through life without experience, I think that there's just something missing. Now, I know that some people are not intended to have kids. We know that.
Right.
Not everybody is born to be a parent. But boy, my life would seem so much less if I didn't have kids.
Yeah.
I would venture to say that the most powerful words in our language are mama and papa.
Yeah?
Yeah.
I mean, when you hear that, there is a sense of responsibility and love that comes with it that you can't describe until that happens.
Yeah. And it just completes your family, and it gives your life a whole new purpose, I think.
Yeah. So we could easily make this the topic of the show. I don't know if our audience is interested in this topic. Most of our audience has grandkids.
Right.
And so they're getting some of the great benefits of that. I've not had that experience, but I'm told it's like no other. I'm told in some ways it's better than parenthood.
Sure, you give the kids back.
Right.
At the end of the day.
They go home.
Yeah. So that I guess we can segue from this into talking about money. So people now who I'm going to try to profile some of our listeners. And those of you who I miss, hang on, because we're going to get various circumstances. But I think a lot of our people are, they have adult children. They probably have children who are maybe able to be some help to them, but most of them don't want it. As a matter of fact, that's almost universal what I've seen. Is older people, though their kids may be doing well financially, they don't want any help from kids. It's a matter of pride or something. So they're trying to figure out in this mess, pardon the word, in this mess that we're in now, what do you do with your money? Some people are saying this is a bubble, that the stock's going up, it's insane, it's irrational exuberance. And then others who are saying, and some authorities are backing this up, no, the market's not overpriced. It has a long way to go. It's a new world. We have technology now, so we're just now starting to see these incredible new changes. That has value, and that explains the market going up, 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 up. I heard Kathy Wood making this argument recently. She had, you know this, but our audience doesn't. She heads a fund called ARK, A-R-K, and it's a very popular ETFs, and she has a lot of influence. And she argues that what happened in 2000 when the market crashed, the dot-com market, was that it was too early. That technology that just emerged then was only in its very infant stages, and as a result is far premature to assign it the values. But she says now it's yielding fruit. You know, it's budded, it's bloomed, and that now we're in for this wonderful era. So I can see how people who are, say, 75 years old, they don't have a lot of room for error for reasons we talked about.
Not at all. Mm-mm.
And they're trying to decide, should I be running from this market? Should I be embracing this market? And so now I've set it up for you, John. Give us the answers.
That's a great setup, and that's a common question. We've seen the markets really rally since the pandemic to pre-pandemic levels in almost every sector. One of the things that we have to keep in mind is interest rates. Monetary policy, the Fed has kept interest rates so low. If you go buy a bank CD for 1 year, you're probably going to get a 0.3%. It's hard to put your money in fixed income with interest rates being so low, because if you're buying short-term investments, you're not getting much of a yield. If you're buying long-term investments and interest rates are low, interest rates and prices have an inverse relationship. So once the Fed starts ticking those interest rates up, your prices are probably going to fall if you have fixed income currently.
And you think, though, that the Fed will not be able to keep rates from going up or maybe even incentivize it?
The projections show that they're not planning on doing anything drastic till 2023 to help stimulate the economy. But there's been a flux or there's been a lot of people going towards equities just because you have to go that way to get some kind of return on your money. I would venture to say if you're retired and you're in that situation where you don't know what to do next, you hopefully you had a game plan going into pre-pandemic situations and then after pandemic. It shouldn't change much. Maybe some of your allocations in your portfolio might change. Maybe you go from having long-term bonds to shorter-term bonds that are less price-sensitive or interest rate sensitive. Maybe you're switching now from growth to maybe value stocks because we've seen a pullback in growth, a correction in technology, and a flight toward value. So maybe that's a good time to not necessarily change your allocations in a whole, but the type of investments within those allocations.
And John, without getting too political, what are some concerns with this new administration in the White House in terms of retiring? What are your thoughts on that?
What I'm concerned about is the tax bracket. We've put out so much stimulus money. We're running about $28 trillion in debt. The government at some point is going to want that money back to help pay down the deficit.
Which means raising taxes.
Which means fiscal policy, you almost have to raise taxes for everybody. We're going to see the middle class, probably, obviously the upper class, foreign trade. We might see the corporate tax rate go back up.
I think that's coming, yeah. And what makes this really likely is that it's not for this administration a necessary evil. Instead, it is a necessary evil in reality, but as influential than that is that it's an ideological theme about people paying more taxes who have more money. And so I think there's a lot of support for that politically, that even in the absence of this necessary evil, meaning the absence of the necessity you describe, even if that weren't there, I would say in this administration, you're going to see tax rates go up. And wealthy is going to be defined increasingly lower. Don't you agree?
Yes, I think upper middle class will become what they consider wealthy. Middle class will be folks that maybe were below middle class. I just think that's inevitable. And I do think it's a political thing or political party measurement. So, yeah, I do see that happening.
You know, there'll be so much support for that. And in effect, it's a redistribution. So when you increase taxes, what you're accomplishing is you're taking the money into the central government, largely central government, and you're redistributing it in programs and whatnot that will address primarily members of the lower classes. And there's just so much philosophical support for that.
Yeah.
There is.
And now you throw in a good excuse for doing it. I mean, a good reason. And more than excuse, as you suggest, is probably a good reason, because it is difficult if we don't bring in some tax revenue to fix this spending deficit.
Absolutely. I don't see the spending going down. We have another stimulus package going out in another couple of weeks.
Right.
People are going to be getting another $1,400. So where does it end? We don't know. But I think one of the obvious solutions to the problem is higher tax rates for everyone.
Yeah.
Or at least the middle class and the upper class. So I would venture to say if you're retired, consider at this point looking into how do I save on taxes? Or let's say that you're currently working and you're getting close to retirement. There's such thing as traditional IRAs or traditional 401ks, and then there's Roth. Traditional, you make pre-qualifying contributions or pre-tax contributions to the account, and you get a tax break today. Well, maybe there's an opportunity to make Roth contributions. So you pay the taxes on that money today, but when you take it out later in retirement, you're not taxed.
Is that how you're advising clients right now in 2021?
It depends on everybody's situation.
Right.
But if you are working and let's say your employer does have a Roth contribution election, and you've previously been putting money in traditional 401k elections, you might consider going to the Roth option.
So rolling over the 401k to...
Not necessarily rolling it over, but making different kinds of contributions, either pre-tax or post-tax contributions.
But another option would be, assuming the plan permits it, is to take money that is pre-tax and to make it post-tax, the existing money, rather than future contributions.
Yes.
I know that's a big decision to take, for example, $1 million that might be sitting in a 401k or an IRA and deciding that you're going to go ahead and take the tax hit now in order to avoid a higher rate in the future. That math is difficult, right? Because by leaving it in there, even with a higher rate, you're compounding, though, in the meantime, without paying taxes.
That's absolutely correct. And you got to remember, we're betting on tax rates going up. It's not a definite. But you're taking money that is pre-taxed, you're converting that over to taxable money, and it's going to be taxable all in 1 year. So that's something that you definitely want to work with a CPA. And it might be something, let's say you have $1 million. Maybe you're doing $250,000 per year for the next 4 years to space that tax burden out.
Right. And we've talked on the show before about the 4% rule. And if you can explain that again, how does that work?
Sure. The 4% rule, I consider it 10-4. You save 10% during your working years, and then you plan on taking 4% out in retirement. It's a rule of thumb. Go ahead,
So
Joe,
you save 10% of net or gross?
I prefer gross.
Okay, that's a big ask.
It's a larger number. That's why I say that. And then you plan on taking out 4% in retirement, and hopefully you don't outlive your money. Now, if you get a later start to retiring, 10% isn't going to be enough. So starting earlier is going to be better, and there's no substitute for lost time. The 4% gets a little iffy because you have required minimum distributions with a lot of accounts, with your qualified accounts, and a lot of times you have to take out more than 4%. So now you can reinvest those funds in a non-qualified account, but now you have to take a little bit more financial planning. It takes a little bit more insight to get those things going than just taking out your money and spending it.
Okay.
And some have questioned whether that produces enough money for your entire lifespan. And remember, those of you who are doing the math and thinking, wait, that's 25 years at 4% a year, so it's all gone. But the way the math works is there would still be money there because you're always doing 4%. So the other 96% is growing. So it really should get you through a pretty long life if you start doing that in your, say, late 60s. But should we take a break?
I think we should.
Okay, let's take a quick break. We'll be back in a few moments with Elder Talk with financial planner John Gallia.
We were lost. We were in over our head. We knew it, and we needed help.
She had dementia and probably Alzheimer's.
And you're not prepared for it at all.
TuckerAllen was helpful in making decisions about end-of-life care, power of attorney for financial care, things I never even would have thought of.
They were very thorough, very warm.
That warmth helped us all relax in a very difficult situation.
It was a great relief.
Welcome. We're here with Elder Talk with John Gallia. John Gallia is a certified financial planner. I'm a big fan of certified financial planners. I would suggest those of you who do not have a planner, when you look for a planner, that's an important designation. Don't confuse it with a stockbroker. Stockbrokers, and not to diminish them at all, but they are not trained in financial planning. And they're not trained a whole lot in investments either. And I think it'd be hard for my stockbroker friends to argue with that. But they do have some training, of course. What is it, Series 7?
Series 7, Series 66, typically.
Yeah, so these are designations that you can get, which I assume is through the SEC.
Through the SEC.
Yeah, so it does mean that you learn something about investments, but it doesn't mean you learn about family or couple or even individual financial planning. Financial planning includes knowing about investments, but it includes a lot of other stuff too. Insurance, taxes, what else? Retirement plans. So anyway, I am a huge fan of certified financial planners. Obviously, I'm a fan of John's, but my important point here is to say that certified financial planners earn their money, and too often people charge forward and just have somebody handles their investments, their stockbroker, and they never have a financial planner.
Right.
They do it all on their own, which is a little scary. So, because it's a hard thing to know, and people who are certified financial planners take this, I think it's a 2 or 3 day test.
Yeah, it used to be that way. When I took it, it was a 2-day, 10-hour test. Now I think they broke it up. Now it's available online.
In modules?
Yeah. Before they used to stick you in a room with a piece of paper and have you work for 2 days for 10 hours. It was tough.
That was like a CPA
pretty
exam.
grueling.
It was grueling.
Yeah.
And you better make good erase marks because if you're one off, that Scantron sheet just failed you.
Yeah, that's right. And CPA exam, which I took and passed, of course, and regard as a hard test. I can tell you that certified financial planning exam that I've looked into, and I've not taken it, but it's pretty meaty. There's a lot of challenging stuff in there. So I won't dwell on this, but one of the walkaways from this session would be that you guys should look into having a certified financial planner, and John focuses specifically on older people, but I don't want people listening to this to think that I'm selling John's services. Foremost, I'm arguing to you that you should have a certified financial planner. Having said that, so tell me about the people, your clients who are over 60. What situation are they in now that they've gone through this pandemic? I assume they didn't have the chance to spend money, especially the people who've been locked down, and people over 65 largely were.
Sure.
Just on home improvements, mainly.
Well, those
it.
people didn't even go to Lowe's. I mean,
right.
I mean, these are people that I don't see how they spend any of their money. If they're like my mother, for example,
yes,
who she's pretty much stayed in the house, and I've even encouraged her to get out more because I didn't think it was that big of a risk. But she was one of those seniors who, really took it to heart.
Yeah, I went to the store yesterday. I had to get my 3-year-old out of the house to burn some energy, and it was raining. And I would have thought it was Christmas spending season. The stores, every store I went into, lines were out the door. I didn't get a memo. I didn't know what was going on.
Was this the $1,400 check that people are receiving?
You know what? I didn't think of that,
Yeah,
but it
because
could have been.
I think some of them went out over the weekend or were supposed to, I believe.
Yeah. Yeah, that very well could have been why the stores were packed. It was amazing. I haven't seen that many people in stores since pre-pandemic.
So tell me what you're finding among your clients that are over 65.
Sure. I think for the most part, all the clients, including the ones that are over 65, there was a lack of spending during the pandemic. Number one, fears of where the market's going to go and what my account levels are going to be in the next 3, 6 months, 1 year time frame. And then there was just a lack of what you could purchase or discretionary spending. You're not going on vacation. So I think people, for the most part, their wealth, if they were retired, is probably increased.
Mm-hmm.
Yeah, it should have. I mean, after that dip last March, it's really been up, away, right?
Right.
Absolutely. We're back at pre-pandemic levels with virtually almost every sector. So they're probably sitting on a little bit more money and discretionary money than what they have in the past. And it's not just retirees, but also folks that are working. Unless you were out of a job, then probably your savings are a little bit lower.
Sure.
But if you continued to work and you just got $2,000 or $3,000 worth of stimulus package, you're in a better financial situation than what you were a year ago.
And we've talked about the different stages of retirement. Well, let me see if I can remember. Go-go, slow-go, and no-go.
Correct.
So go-go is obviously where you're spending the most at the beginning of your retirement, the first, 5-10 years, I think you said?
Yes.
Okay. And it appears that the pandemic is fading. But would you recommend, someone that is retiring this year, 2021, that maybe they hold off on spending as much just in case there's a resurgence?
And I'll circle this back to what Joe said about holistic planning as opposed to just hiring a stockbroker or a money manager to manage your investments. This is where holistic planning comes into place. So when you sit down with a CFP or a financial advisor, they should be going over how much income you can afford to spend in retirement. So they should take into account your Social Security, your pensions, a nominal return on your investments over a period of time. And they should tell you how much, all right, this is my optimal amount that I can spend per year, also assuming that inflation is around 2.5-3% per year. Cost of living goes up. And I should feel good that way. And if you've done that and you're within those means, you should feel confident retiring and spending that amount of money. If you haven't done it, then you're flying blind. And that's what's scary.
But given this scenario of go-go, which I think is great, no-go, slow-go, and go-go, slow-go, and no-go. So those are phases where, as we get older, we slow down. But in that initial phase, you would think more money would be needed. But is it dangerous for people to say, look, I'm going to be doing most of my traveling over the next 10 years. So I expect to spend more, and it'll be okay because I won't be traveling my last 10 years or 7 years or whatever. Is it okay to develop a plan that calls for more spending in that early period?
I worry about the later years because you're not spending on traveling, but you're spending on medical costs. Healthcare, somebody coming into your home, helping you out, assisted living.
Things that may not be covered.
May not be covered. They're unknowns. You may never have that, but statistically about 70% of folks would qualify for some sort of long-term care need
for some
at
period.
some point in their life. Correct. So
that's an important statistic. I read that too. 70%. It's gotten higher.
Mm-hmm.
Yes.
So it assumes, as you said, some period of time when you're going to need some sort of institutional care of some sort. And I think that included assisted living and not necessarily skilled care, but it would include skilled care.
Correct. Even home care. As long as you have two activities of daily living that you can't perform, toileting, eating, dressing, there's 3 others.
Bathing,
transporting. You would qualify for some sort of long-term care benefit. So
70%.
70% of folks at some point will have something happen to where they would qualify for it, but 70% of folks don't have money set aside for it.
And a lot of that is not paid for.
A lot
for
of
example,
that is not.
I mean, some things are, we know, but even if we're talking about assisted living, for the most part, even if you're poor, Medicaid doesn't cover that. Now, this may change with this administration. So at least you take consolation if you're thinking, well, if I need to be in a nursing home, worst case scenario, once I've spent everything I have, then thank God then I'll be able to have that paid for. Well, you can't even say that if you're talking about assisted living.
right,
That's correct.
I mean, you can be broke and still not qualify.
right.
That's why I say you always got to be kind to your kids.
Kids are an investment, right?
They are an investment,
Yes.
But, investments can go bad.
That's right. That's right.
Right.
But you find people in that kind of situation to where kids or relatives or somebody has to step up, or they're living in dire situations. And I hope that's for none of the listeners here. And I think with good planning, you can help prevent that.
Right. And deciding on when to take Social Security. I mean, if you wait, doesn't it increase by 8% the longer you wait by each year or something?
Yes, if we only had that crystal ball of when we knew we were going to die, I would be able to tell you to the day what the optimal day is to start your Social Security, but we don't. So when I talk to somebody about Social Security, typically they start when they retire.
Which may be at 65.
Which may be at 65. That's when Medicare comes in, so that's a popular time to retire at 65 when you start getting some health insurance subsidies. So you can start at 62. That's considered early retirement. Normal retirement for most folks, where you would receive full retirement benefits, is about 66 years old and 10 months, somewhere in
That's
there.
the new date. That's
the new date.
Creeping up, depending on your birth date, I think.
Correct. So any time, if you go a year and postpone Social Security, that's about an 8% difference in your payout. So what I say to folks is you start taking Social Security when you need it. If you need it at 62, if you plan on retiring and we can factor that into a budget, start taking it at 62. If you can hold off to 65, start taking it at 65. If you can hold off to full retirement, start taking it then. I'm not a huge fan of necessarily putting it off to 70 years old, even though you're getting an 8% increase, because what happens if you only live 5 more years?
Right. Then it was all for nothing.
You left a lot of money on the table.
Yeah, and some people do that analysis in which you take the amount of money, they assume the money you start taking early is placed in an investment, and it accumulates at some rate of interest. So it's an easy way to think then about whether it makes sense to take it earlier or later. You still have the issue of how long are you going to live, so you can't get rid of that. But you can identify your break-even number by, in other words, the year at which it went from not making sense to making sense, by first assuming that, okay, I will take full payments at 70. And then for analytic purposes, if you're age 62, whatever the earliest now you can take it, and you take that money, you assume it goes into an account like an annuity, a reverse annuity. So you're depositing it into an account, and it's earning some rate of interest. So you reach age 70, you didn't spend any of the money. Even though you started taking it, you didn't spend it. So for analytic purposes, you can do that math and say, okay, when I reach age 70, I'll have a check for a certain amount of money that I wouldn't have had otherwise. Now you have a lower payment, though, from then on, because remember, in this scenario, you took it early. So what you'll get from age 70 on will be a lower check because you took it early, but you'll have this pot of money, which you will have done the math and determined what it will be based on your expected income. And then At what point do you distribute that out and explain the difference between the money that you got after age 70, having taken it early, versus the higher amount you would have gotten if you waited till 70? So when you think about it that way, as a pot that you accumulate and you get, you don't spend when you start getting it, you save. That to me is a good way to think about.
I think so too. And depending on what you invest in, that's also going to determine your return or your break-even point. I've typically, and I've run these numbers before, typically for full retirement versus 62 years old. And I find kind of the sweet spot with maybe a 5% return on your money, which is pretty average. About 15 to 20 years is your break-even. The longer you put it off, obviously, the longer it's going to take to hit your break even.
Yeah.
But you're hovering right around there.
What percentage of your clients do wait till they're age 70 to start collecting Social Security benefits? I'm just curious.
I would say very few.
Yeah.
I would say very few. I would say most people will start at full retirement, but people that go beyond 70 or go beyond that are ones that are still working. And unless they're still working, they've pretty much started Social Security.
What percent of your clients quit working at 65 or before?
The percentage that quit working or want to quit working. Those are two different numbers.
Yeah, very different.
That's an important point. Yeah.
You know, being a financial advisor, everybody has different kind of clientele. But I will say the majority of folks at least work until 65 years old. There are some exceptions to where if you have a government pension or a really outstanding corporate pension, which are becoming few and far between these days, people can retire at younger ages. But you still have to fill in that gap of health insurance, which is pretty significant when you're self-funding from 62 to 65 or 60 to 65, or let's say you retire at 55 with a really nice government pension. Hopefully you have some sort of benefit that will help float the cost of healthcare insurance for 10 years.
Right.
And if we assume, as I think we safely can, that we're going to have a period of significant inflation for some period of time. Maybe it's 5 years, maybe it's 10 years. But it's something that our audience remembers. You know, I have to tell my daughters what inflation's like because it's something they've read about, but they don't know anything about. But we remember, I don't know if you do, I remember the 70s.
70s, Jimmy Carter.
Yeah, and I remember what it was like to have inflation, double-digit inflation. It didn't go on for a real long time, but it went on for almost that whole decade. Maybe not double digits the whole decade, but inflation was something that America had come to terms with. And so all of your decisions were based on that expectation. So people quit including that expectation because it hasn't been significant, some would argue, in recent years. Others would say that, in fact, we have had this stealth inflation. It's just been unacknowledged, but yet felt. So I think that now many people, and I'm curious as to whether you agree, will see inflation over the next 5 years plus. So it behooves them to have their money in places where they're going to get some adjustment for that. And I know some pension plans are designed to adjust for the consumer price index. I think federal plans do that, don't they? Yes. So what about Social Security? Is there a built-in adjustment for inflation with Social Security? Do you know?
There's a cost of living adjustment with Social Security.
Okay, yeah.
Don't get me wrong, it doesn't match inflation. But there's a cost of living adjustment that comes with Social Security.
And it's not much, right?
It's not much. It might be 1.5% if there's 3% inflation. It might be 2% if there's 3% inflation. But there's a little bit of an adjustment that you can get from Social Security, which is
that's good to hear.
A benefit.
Even if it doesn't reflect fully inflation, just the idea that it's going to go up as inflation goes up.
Correct. The program was designed that way. So hopefully it continues on. It really depends on the security of our Social Security system.
So going back then to something you said a while ago, when we opened the show, you were talking about the fact that some people, out of a sense of fear that they may run out of money, they want some fixed income investments. And I want to be sure on this show, we really try to not get a lot of technical language that we don't take time to explain. I know that some people, would love to watch, for example, CNBC, but you watch CNBC, unless you're somebody who follows these sorts of things, it's not helpful to you. So we talk about fixed income. We're talking largely about bonds and anything where you have a certain amount of money that may not be adjusted for inflation.
Yeah, anything that really has a coupon that has a maturity is pretty much considered fixed income. Can be a CD, can be a bond, can be a treasury bill, treasury note, savings bonds. Those are all types of fixed income. So it's not necessarily, the fixed income isn't going to move with the market, the stock market, right? It's going to move with interest rates. And typically the 10-year treasury is what they base the interest rates off of.
And when you say it's going to move with interest rates, some people are thinking, wait, but it's a fixed percentage. And we need to explain that really you're talking about the value of the bond.
Sure. Bonds trade on the market every day of the week, just like stocks. So if I have a fixed income investment, let's say it's a corporate bond and it pays 4%, and that was the going rate when I bought it, 4%. I bought it at $1,000 or par. I bought one at $1,000 at 4%. Let's say interest rates tick up. And now I can buy that same bond, same amount of years at 5%. If I went and I tried to sell that bond that I own, that I have a 4% coupon on, I'm going to have to discount it because I got to match today's interest rates. Vice versa, it works the opposite direction. If I bought that 4% bond at par value, and let's say interest rates fall to 3%, then my bond that pays 4% is more desirable. So I can build in a premium to match the market price, so I'm going to get more for that bond. So that's how typically bonds work, fixed income works. The shorter the term, the less interest rate sensitive they are. If something is maturing, if your bond is maturing tomorrow, who cares what interest rates are today? You're not going to sell it today. It's just going to mature, right? So they're not going to be as interest rate sensitive. Something longer term, if you're looking 30 years down the road, 25 years down the road, those products are going to be a little bit more interest rate sensitive.
And if we could get back to healthcare and talk about signing up for Medicare, you have to really consider your spouse. In fact, I know someone that he prolonged retirement because his spouse was younger, and he knew when he retired, she had health insurance through his workplace, and she would no longer have that because she would not qualify for Medicare. How do you advise clients in those types of situations?
Sure. I think that is one of the main reasons why people continue to work is for healthcare benefits until the age of 65. There are certain things you can do. You can look with maybe your previous employment. Maybe you have a pension. Maybe you were a government worker. You can see if there are any other spouse benefits or benefits for yourself that maybe you can still get on a group policy that is going to be substantially cheaper, at least these days, than getting your own policy. You can look through those previous employers. There is a program called MediShare. And it's sort of popular, it's sort of underground, but unless you have really good health, some of the premiums will remain low. You're going to have a lot of out-of-pocket costs unless you're in really good health. So,
but they don't consider that technically insurance, right?
No, it's a
sharing.
Group of folks coming together. A lot of it's Christian-based where they share the expensive healthcare costs, and instead of paying $1,000 a month premium, it might be $250, $300, but some of the things may not be covered unless you're in really, really good health. We're talking about prescriptions may not be covered for a certain period of time. You might have substantial deductions that you wouldn't normally have through a standardized healthcare plan.
Yeah, and right now, did I read that COBRA is presently being offered free or subsidized for some period of time people who are laid off or transitioning during the COVID period?
I don't really know. It'd be great if it was. I know Cobra, when you leave an employer, is usually pretty cheap for the first couple of months, and then it gets really expensive.
Yeah, then it goes to a market rate as if you went down the street and bought the policy.
Right,
Bought
'cause
the
it's like
policy itself.
$700 a month, I think.
Oh, sometimes. I mean, it can be
1,000 a month.
Yeah, it can be
Yeah.
higher than that. So, immediate, it's a good immediate thing, but it's not good long term to stay on Cobra. But if they are doing some sort of benefit to where they're subsidizing the premium payments, I think that's great.
Yeah, I think I read something about that. But Cobra, in any case, doesn't go beyond typically around, 36 months or so. So are some people then saying, look, I'm 65, I want to still get a good health insurance plan in addition to the Medicare that I'm now qualified for, or maybe even they're 62, and they want to go ahead and change their employment. They do have a health insurance concern. They could just go get another job doing something they enjoy, right, without regard really to the pay.
I think that most people, when they hit that stage in their life, and if that is their viable option,
Right.
the reward is the healthcare benefit, not necessarily the comp. People aren't looking for the comp, they're looking for the healthcare benefit. You've already retired from your exhausting job. Now you want a job that's enjoyable, and the first thing I'm going to look at are the health benefits. Second, salary.
Yeah. And salary may be even less important if they're taking some Social Security at that point.
Correct?
Yeah.
So do you have people then who are changing, who instead of retiring are changing into a new career or just a different job? And are they tending to work just part-time or full-time? And what kind of jobs do you see attract people in their retirement years, quote-unquote retirement?
That's a great question. It's funny. Some of the folks that retire, what they end up doing, it tends to always be in line with something that they were doing before. If they were a teacher, they're doing some kind of tutoring or working for a curriculum plan.
Or consulting.
Consulting.
Yeah.
I know somebody that used to run an auto dealership, and now he's part-time delivering auto parts to stores and loves it. He's just schmoozing, dropping off parts. So those kind of jobs are out there. I don't see folks getting too far away from their passion or what their preoccupations were before. But yeah, there are people out there enjoying and finding work that is less hectic than what they had to do and getting healthcare benefits.
Yeah. And
Typically it's part-time.
And you hear of a lot of retirees doing something like working in a lawn and garden center because they love gardening.
Yeah,
they
my
love
wife
that
would love
atmosphere.
that.
Yeah.
Sure.
Yeah.
Mm-hmm. And I've often thought that it'd be cool to be a guide or a tour guide in some of these historic properties and historic landmarks and houses where you'll have somebody there who's like a docent or I don't know what you call them, but they guide you through the house.
Sure.
And they give you the history. And I'm a fan of history. So I always thought, now that wouldn't be work. But on the other hand, it wouldn't pay very much either.
No.
I thought the same thing. I like fishing. I like fly fishing. Maybe going out to one of these big rivers and being a guide.
Guide, yeah.
And I'd get to pick the days that I would work, and I would take people out and I'd have them catch fish, and they'd be happy.
Right.
You can't have a bad day, right? It's
No.
not real work. I'm sure it is, but
Yeah. I talked to a guy who had actually done that. He retired from a career, and he was in Wyoming. This was near Cheyenne.
okay.
And you have to be able to deal with bears and whatnot. To me, I thought that sounded like a rough job for a guy in retirement.
Sure.
Yeah.
Sure.
That there are definitely some occupational hazards.
Right.
But he would take out these rich guys, 3 or 4 or 5 of them, for a weekend. He's responsible for their safety.
Oh,
In
boy.
addition to everything else. So
Imagine that kind of pressure.
So you can have that job. I think I would
Okay.
stick with that.
Stay away from the bears.
Right. Make a lot of noise.
So what else should we talk about as we wrap up here? Things that we know that people are concerned about now in terms of their finances. What other suggestions or tips?
I would venture to say, it's a good time to meet with your professional, go over your allocations if you're concerned about that with the market being so high. Go over your strategies that you have in place. Discuss your tax consequences for taxable money, non-qualified versus qualified money, how much you need to live off of, and come up with a soundproof plan that isn't going to change through maybe a 10%, 15% market correction, and isn't going to change if we have another 10% increase in the market.
But you're then a big fan, I take it, of dividing your funds in some proportion between what we've called fixed income, things such as bonds, and et cetera, and securities. Are you a follower of that school of thought?
I am a big fan of that. Now, obviously, when you get closer to retirement, you need a little bit more fixed income. Most people need a little bit of fixed income in their portfolios to hedge against market risk, because if you're taking out 4% of your portfolio, or let's say you have to take out 8% just to fund your living costs, you can't afford a 30 to 40% drop in your portfolio. That's going to be tough to have that kind of rebound. The younger you are, and if you're not needing those funds and you have a longer time towards retirement, you can obviously go a little bit more equity focused than somebody that is 65, 70 years old. There's also other products out there, and I'll quickly mention this, and I don't really like talking about products on the air, but there is a new craze on products with downside risk buffers that we're seeing. You'll get a certain market capitalization or appreciation rate. It'll be capped, but you'll also have a downside risk buffer of maybe 10, 20%, depending on what those are. So we're starting to see those available in annuity products and also ETFs that might be a valuable option for some folks.
So it guarantees a minimum rate of return, and yet if the market were to collapse, you can lose no more than, say, 10% of your money.
It doesn't guarantee a rate of return, but it allows you to invest in maybe 100% equity, maybe 100% S&P 500, okay? And if it increases 20%, you might see the first 20%. If it does nothing, you're not going to see any gains.
Okay.
But what you're giving up you're also getting is downside risk protection. So maybe the first 20%, if you have a market correction, or the first 10%, if there's a market correction, is forgiven.
So do those products include things that pay dividends well as a substitute?
Typically not. Typically you're following an index, and that's about it. Now, as things evolve, products evolve, investments evolve. That's also another reason to work with a financial professional. Something like this wasn't available a couple of years ago. Right. So investments evolve. So, I would recommend, if this is something that you're interested in, definitely talk to a financial advisor, see how it works, and see if it's good for a portion of your funds if you're concerned about downside risk.
Very good. I think a point we may have to wrap up with. So as always, I think we did cover a lot of territory here. We try to keep it relevant. So I know that you're popular with our audience. We've had you on, this is the third time at least?
Fourth, maybe.
Yeah.
3 or 4, somewhere in between.
So John Gallia it's Gallia Wealth Management Group.
Correct.
Thank you. Interesting as always.
Thanks for having me.
This has been another episode of Elder Talk. Till next time, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.